Greetings, traders. I hope you're having a great day wherever you are in the world. It's the 28th of January, 2021. So the pandemic has been on us now for about a year. I thought it was important to put together a couple of videos to present the holy grail of trading. And yes, there is a holy grail for successful trading. Absolutely. But it's probably not what you're expecting. So this will be the first in a series of steps to achieve consistent profitability, which basically equates to the holy grail in trading. Think about it. If you are consistently profitable trading the markets, whichever market it is, that's it. That's the holy grail. That's the success that we're all striving to achieve. Having said that, all contents on this channel and these videos are based on my experience, my opinions, and my observations. They are not in any way trading advice, psychological advice. I'm not a doctor. I'm not a shrink. None of that stuff. This is my opinion, and this channel is essentially my video trading journal to record and learn from myself, as well as anybody who cares to come here and find value in what's shared on this channel. So this disclaimer, is required. Everybody understands that. You hear it all the time. And of course, past performance is not indicative of future results. There we have it. Let's move on and get down to it here. You need to consider that you are preparing to succeed and not to fail. You are, in essence, starting your own financial business. You're an entrepreneur. It's a serious business. It's not a video game. It's not a hobby. It can be both of those things. But if you're trying to follow these thoughts, and the theme of this channel, and your goal is to achieve consistent profitability, then it's a serious business. Engaging in the financial markets can be unbelievably rewarding. I mean, there's no upside. If you do it right, you can make more money than most people ever make in their life. But you have to understand that and be realistic about the perspectives of the business that you're getting ready to start. It's a lot of work, and you must invest a lot of time and effort to succeed. Now, before you've spent $1 funding an account or picked out a broker or looked at some charts, you've got to go take a look in the mirror, or however you do it, and engage in some serious introspection. You need to ask yourself questions like, where are you in life? Are you 70? Are you 25? Obviously, huge impact on your decision, what markets to trade, how much risk capital you have, all the criteria that will go into starting your new business. What temperament do you have? Do you think fast? Do you think slow? Are you risk-seeking or risk-adverse? Are you disciplined in other aspects of your life? If you're flopped on the couch in the middle of the afternoon watching this video on your telephone because you're internet was cut off and you got a beer in one hand and a bag of potato chips in the other, you may not be cut out for trading. And I don't say that to insult you. I say that to tell you the truth. Trading is a solitary business. Unless you find yourself fortunate to be involved or be hired or picked up by a prop shop where you have a structured environment, you get up in the morning, you go to work, you sit in a group with other people and you trade, that's different. And that's one thing. But by and large, for the vast majority of traders, it's a solitary business where you sit by yourself in front of the screens in a room where it's dark and it's quiet so that you can focus, and you have to be extremely self-disciplined because nobody's there but you. Nobody's going to tell you when to go to work. Nobody's going to tell you how to focus. Nobody's going to tell you what to do. Nobody's going to tell you, how many days a week you have to work. This is all up to you. So you've got to have self-discipline and you've got to have a plan. Having said that, let's imagine that you feel you are suited to this and that you want to make the commitment. So you need to identify what market and what product you're interested to trade and that suits your temperament and all those things that you discovered in your moment of introspection. First things first would be the thing that you see all over the news, the equities markets, stocks, the New York Stock Exchange. Okay. If you have $25,000 minimum to invest in your trading account, then you could consider trading stocks on an intraday basis. And when I talk about trading, I mean an active trader where you trade frequently, usually 1 or 2 times or more within a day. An investor, in my opinion, or swing trader is someone that makes a trade a week or trade, sometimes a trade every month or two, whatever it is. Then you don't fall under the pattern day trader rules and you can actually have a smaller account. But we're going to talk about trading here. So assuming you don't have $25,000 to deposit, the next option would be options, no pun intended, which are a derivative of the Forex and the futures and the stocks, equities markets, but they are expensive, they're highly leveraged, they're complex, and I don't advise a new trader getting involved with options until you've been around the block so that you know what's going on. You've spent a lot of time learning about them, and they are highly leveraged and they're expensive. Now, you hear a lot of stuff on the internet, people recommending you get into options. And one of the reasons for that is the spreads and the commissions are extremely high, much higher in options than they are in futures. And if someone has an introducing broker agreement with a brokerage house, then they get paid more money for having you sign up for options than they do a futures account. And that's unfortunately what drives a lot of people on the internet or on YouTube. If you think you are interested in options, I suggest that you only buy calls thinking the stock's going to go out or that the options will improve, or puts thinking that the market will go down, and do not, under any circumstances, sell premium, because you can be upside down for huge amounts of money before you know what hit you. So that's all I'm going to say about options. I don't trade them, obviously, and I'm one thing at a time. There may come a day where I do, but at the moment I focus on futures. That brings us to the Forex market, which is essentially the Wild West. It's not regulated. Most importantly, there is no central marketplace. Large majority of the time with Forex brokers, they are taking the other side of your trade. In other words, they're trading against you. You go long, they sell you the stock, they sell you the it's not even a contract. They take the other side of your trade In other words, they make money when you lose. And I don't like that kind of a situation. The futures market, however, in America is without a doubt the most regulated, highly transparent, equal playing field, and most importantly to me, it's a zero-sum game. Every time I buy a futures contract, another trader just like me sells it. If I sell one, a trader just like me buys it. There's two sides to every trade, and it's another trader. It's not a broker. It's not the futures exchange. It's another trader. The brokers in the futures exchange, the CME or the CBOE, make their money on some data feeds and round turns, commissions, and the brokers make it on the commission for the round turn also. So they don't have their vested interest is for you to succeed. Not they don't make money when you fail. So, in my opinion, the futures market is without a doubt the best. Now let's talk about your capital. You establish that your personality and psychology is all proper and that you've got what it takes. And you need to identify the risk capital for the style of market you plan to trade. Do you know what risk capital is? If you don't, it's going to 99% chance you'll fail. Do you know what emotional capital is? If you don't, 100% chance you're going to fail. These are the basics. These are the basic pillars of the Holy Grail for trading. These are the real things, the real components that, when put together and understood properly, makes you a successful, consistently profitable trader. You have the tools and the skills to do that. Let's move on. Quick definition of each, and not to belittle them because they are two of the most important components of the Holy Grail and for or trading success. Risk capital is objective. It must be identified and absolutely respected. Risk capital is simply money that if you lose it, there will be absolutely no negative impact on you, your life, your family, whatever, etc. You know, no negative impact whatsoever. Think of it in terms of you go out to dinner, you buy a bottle of wine, you have a lovely dinner, enjoy your wine, you go home, some hours later, you use the toilet. Are you emotional? Are you nervous? Or do you have anxiety? Of course not. But that money that you spent on dinner and wine just went down the drain. Essentially, that's the same mindset that needs to surround risk capital. Obviously, this is a new business. You're starting, okay? This is your new business, and you want to preserve your risk capital and you want to grow your risk capital. That's how you will be successful. So the analogy breaks down at that point. However, scared money can't trade. That's a well understood saying in the trading world. Also, another good one that I like is money is just the way we keep score in the game we're playing. And that's basically what it is. If you think of it as just a score, like your golf game or whatever game you might play that has a score associated with it, instead of money, what you're trying to do is you're trying to alleviate the fixation and the focus on money and the things that it can do to you psychologically, which is your emotional capital, worry, stress, poor decisions, don't see the market clearly, et cetera, et cetera. That's why risk capital is so important, and it must be money that you don't need to have. You can lose it, you can risk it, and it will not have any negative impact on your life or your family or anything else. Emotional capital, which I've kind of alluded to here, is subjective, right? It's emotional. It's part of you. It's psychological. It's elusive. It's to identify. You got and control. Uh, Yet it's probably more important than risk capital because money you can get more of. Psychological damage can take a long time to repair and have huge negative impact on things that you do going forward. For example, it's Friday afternoon. You have a moment of complete mental lapse and you are in a losing trade. You move your stops, you average down. Suddenly you realize that the market's getting ready to close. You're $1,000 down. You have a $2,500 account and you have to take that loss. All weekend long, you're going to be thinking of all the stupid things you did and that you lost 40% of your capital. How do you suppose you're going to feel on Monday morning? How do you think you'll trade? That's risk, emotional capital that you've just lost a lot of. And you can see that you did lose $1,000 worth of risk capital, but your emotional capital, how do you get it back? How hard is it to recover? What impact will that damage have on you Monday, Tuesday, Wednesday? The next week when you're trying to trade, will you try to revenge trade? Will you try to do more stupid things and then blow up your account? That's the emotional capital come into play. Okay, we have figured that you understand what markets you want. Now we're going to look at products and we're going to get into the nitty gritty of how you control your risk and your money management and your edge. Your goal as a trader is to optimize your position size and risk to achieve maximum expectancy from your edge. What is an edge? You hear them talk about it all over YouTube, the internet, like it's some secret, mystical thing. A lot of gurus online will be happy to sell you one. Well, let me pull back the veil. An edge is simply the probability of one thing happening over the other, period. Nothing more. If you want to send a lot of money to my bank, let me know. I'll give you my bank account. But you get the point. It's simply the probability of one thing happening over another. So let's say that you have a setup or some circumstances that you've identified in the market where it has been proven out historically that 51% of the time the market will go up. The market only can move two ways, up or down. That's something that you have to realize and understand. It doesn't move horizontally in time. It just moves up or down, period. It moves up or down, up or down, up or down, up or down. That's all it does. And time is what we put on it to try to measure our day. But your edge says that it will go, you will have a 51% chance that it will go up. That's an edge. It's not a big one, but it's an edge. And that's all an edge is. Obviously, the object is to identify setups, study as much as you can, and again, past performance is not indicative of future results. You can do back testing till the cows come home, till the market started, and that will not have any impact on your next trade. But it will give you some idea of where you're going and not just be gambling, okay? Now, with risk and money management, there are several variables that go into these three things that will help you achieve consistent profitability and help you stay in the game. And that is simply account size or risk capital, understand probability and losses to a margin call, the volatility of the market you're trading, the contract tick value, and the cost per round turn. Those are all components that go into your decision before you put on a trade. You need to know these things for your risk and money management. Now, I have a tool that I put together, which helps me visualize, helped me in the beginning and helps me now visualize these variables. And I think it might be helpful to other folks, so I will share it with you now. And this is what it looks like. So let's say we're going to input things in yellow, okay? This is your account size. Let's say you have $2,500 to invest. You can either input a percentage of your account that you want to risk, or you can identify it in terms of a trade where you have a 10-tick stop, okay? The margin size of the contract, in this case, this is a future. We'll call it the micro NASDAQ. Tick size is 1, and the tick value, now let's just call this the mini NASDAQ. We'll start with the bigger size. And this is the exchange rate because we're talking dollars, and I trade in dollars, my account's in dollars, so there you go. 1. If you were, trading Malaysian ringgit, it would be 4.5. Anyway, and over here we have the lot size, and our stop is automatically entered if we do here, or if we were to put a percentage, that would calculate the number of ticks for a percent of stop loss, okay? So let's say we're going to trade, we have $2,500 account. The tick value on the NASDAQ mini is $5 per tick. There's 4 ticks in a point. Point is $20. A tick is $5. You're going to trade 2 lots with a 10-lot stop. You can trade 22 times, have 22 losses in a row, concurrent losses in a row, before you have a margin call of $1,000, because there's a $500 margin limit per contract. If you trade 1 lot, you have 80 occurrences, and this graph visualizes what you can achieve here. Now, the probability of that is 8.27 to the minus 25th that you would have 80 occurrences or 80 stop losses in a row with no winners. That's like saying you flip a coin and you get 80 heads in a row, okay? The probability of that is 8.27 to the minus 25th. Big number. However, the thing that you have to consider is, that's an encouraging number, but the thing you have to consider is, as I mentioned on the earlier slide, your object as a trader is to stay in the game and be able to trade tomorrow, okay? So if you have $2,500 account size, you can take 80 occurrences or stops in a row before you have to put in more money, okay? Now let's take a look at, this is how you can select the market and the product you want to trade. Let's take a look at the micro NASDAQ. That happens to be 10 times less size and value than the mini. That's 50 cents per contract, okay? Now you can take 804 occurrences in a row, trading a single contract before you would have to add money. You can make that 2,500, and let's make it a little more realistic. Let's make it 2 contracts, which gives you some other options that I'm going to explain in the next videos, but to do with brackets and trading and probability and those kind of things. But with 2 contracts, you can get 228 occurrences. That means You can take 228 straight losses in a row before you have to add any more money to your account. You can learn a lot about the market and your trade skills and improvements on your psychology and your work on yourself personally and your skills as a trader in 228 trades. A hell of a lot more than you can in 22 trades. Let's look at the E-mini. Everybody talks about that a lot on CNBC and everywhere else. That's $12.50 a tick. Well, there you go. You can take 8 losses in a row. 8. Very, very possible that you could get 8 losses in a row. Brand new trader, didn't know what you were doing. You could just let's imagine the market is trending up and you keep trying to short it because you keep thinking you're going to pick a top. One of the most stupid beginner mistakes that ever happened, pick the tops and bottoms. But anyway, you keep shorting a trend up. Easily, you could go take 8 losses in a row. You could stop 8 times easily. That means you're out of the market in 8 trades. Conceivably, you'd blow up your account one day. You could conceivably blow up your account in one day. Now, one contract, okay, you can get 32 occurrences, still not very many. So this is how you identify what markets you want to trade, right? Crude oil, the E-mini, NASDAQ. You triple your chances. I think it was triple, wasn't it? Triple your chances, basically, or your occurrences to failure or to ruin by just trading a different product in the futures market, in the same indices. You know, it's an indice, just as the E-mini is. It's made up of the top NASDAQ stocks as opposed to the E-mini, which is the top S&P 500. So just something so simple can increase your longevity. And I don't know how to stress it enough, but there's about 2 more aspects to the Holy Grail. But between risk and emotional and risk capital management, money, trade management, what you're seeing here on this tool with this tool are major components to the Holy Grail. And there's only a couple more that I will go through. Can't think of the exact number off the top of my head that I'll go through in the next video or 2. And that will give you every opportunity. Not saying everybody can be a success and achieve consistent profitability, but you will have a fighting chance. And this is exactly how you do it. Here you have 80 chances, right? You can practice 80 times. Here you can practice 804 times before you have to add any money. 804 trades. And this is stop losses in a row. Huge possibility. 9.37 to the minus 243rd power. That probability, that's the odds against that happening. Huge. Meaning that somewhere along this pile of trades over here, you're going to get some winners, which will build your account back up. And then here you go again. Now, we're not going to get into that in this tool because it's too complicated, and that needs to be a Monte Carlo or live trade drill or practice or exercise or whatever you want to call it. But I hope that this is somewhat encouraging to you. It certainly was to me. I look forward to doing the next video. I hope the audio is good here. We're coming up on 30 minutes. I'm going to try to hold these to 30 minutes. If you have any questions or comments, put them in the comments down below the video, and I'll try to answer everything that happens. And I'll enjoy listening to this myself because this is catharsis for me. When you speak out loud and when you teach people something or you share your thoughts, it helps you and it helps me. So thanks very much for watching. And I hope if you are trading, trade safe and manage your risk.